Okay, first up this afternoon, we have a topic that a lot of us have been talking about over the last day and a half. So we're going to delve in depth into it right now. We're going to talk about big data, and in big data when it comes to underwriting. And to lead us off with this panel, we have moderator Jared Hecht, who is the CEO and co-founder of Fundera. Over to you, Jared.
No? We're good. All right. Sounds good.
All right. Got it?
I think we got it.
Cool. Good afternoon. My name is Jared Hecht. I am the co-founder and CEO of Fundera, which is a small business financing marketplace that connects small business owners seeking credit with the best funding providers for their business, many of which are at this conference, like Funding Circle, or even on the panel, like On Deck. It's an honor to be here today with so many innovative companies and leaders that are not only pushing this industry forward, but also creating entirely new markets at the same time. Today, on this panel, we are here to talk about big data. Big data is perhaps one of the most overused and ambiguous terms out there. It's generally tossed around rather loosely to the point where someone mentions it and we nod our heads in agreement, pretending like we generally know what they are talking about. That said, the companies represented on this panel, Lendo, Upstart, Kabbage, and On Deck, do know what they are talking about when it comes to big data. They've used data to automate credit decisioning in a way that I believe will forever transform consumer and commercial lending and set a precedent for expediency and customer experience in loan servicing. Today, on this panel, we'll discuss innovations in how data is being used to perform better credit decisioning and risk management, how it can be harnessed to solve difficult customer acquisition problems. We'll also review the legal hurdles, both domestically and abroad, in applying new data sets to decision making. And lastly, we'll review how data will transform the future of credit decision making and what that means for incumbent traditional lenders and data providers. Before we start, I want to read a rather timely quote. Yesterday, Kabbage announced it raised a $50 million Series D round of financing. Their CEO, Rob Frowine, mentioned that the money would be used to fuel Kabbage's data reactor, which is technology that harnesses data energy. He says, and I quote, "We don't believe in data exhaust. It connotes pollution, a byproduct of a more efficient process. You might as well call it data excrement. We have built a platform that harnesses the value derived from data creation and assimilation, enabling our customers to benefit in a way that was previously unimaginable." End quote. Apparently, big data has now gotten so big in online lending that next year at this conference there will be a panel dedicated entirely to data excrement. Thank you, Rob, for that gem. With that said, let's begin. I'd love to start with panelist introductions. If you could introduce yourself and tell us a little bit about your company. Noah, would you like to start?
Sure, happy to. So Noah Breslin, I'm the CEO of On Deck. We're the leading online direct lender to small businesses in the US. We've deployed over $1 billion of capital over the last 7 years. We'll deploy $1 billion this year alone. And big data, despite its overused term and frequency of it, is near and dear to our heart. It's one of the core competencies we're trying to build in our company.
I'm Paul Gu, co-founder of Upstart. We do consumer lending to the under 30 segment. Typically, this segment is a group of people who have very little traditional credit history and can't be underwritten accurately or at all by traditional lenders. And so we use non-traditional variables such as academic backgrounds and other signals of future success to be able to underwrite this group.
Hi, I'm Jeff Stewart, CEO of Lendo. We extend credit in the emerging markets, places where there's not particularly good credit bureau data. And we use social media footprint and the social media footprint of borrowers' friends to extend credit and get credit to people who otherwise wouldn't be able to get it.
Catherine Petralia, co-founder and COO of Kabbage. In addition to creating fun sound bites, we also provide working capital to small businesses via an automated platform. And we were built actually because of the ability to connect real time to third-party data sources where we could get verified information. And so we use the data not just in origination, we use it on an ongoing basis to make continuous underwriting decisions about our customers and better decisions.
So, Paul, you have a very interesting story on why you started Upstart. Can you tell us a little bit about the context in which it was created?
Sure. So As I said, if you look at the under 30 segment, you see a lot of people who typically have very, very short credit histories. I'm personally an example of one of those people. I'm actually 23 years old, and a few years ago, I went on Lending Club. I also checked a couple of other sites to see what my rate would be if I wanted to apply for a loan. And I found out that pretty much on most websites, I couldn't get approved for anything, despite the fact that I felt like I had a sort of good educational background, sort of reasonable financial credentials for being able to repay a loan of sort of $10,000 or $20,000. And so I thought maybe it's something just wrong with me, and so I asked a lot of my friends who were young graduates working in consulting or banking jobs, typically again very, very good job prospects, sort of employed in high-paying jobs, typically very little debt, clean but not very long credit histories. That is to say, people without delinquencies or without sort of negative marks, but their histories are only 2 or 3 years long. And pretty much nobody could get approved for a loan, and the ones that did were getting approved at 20, 25% APRs, despite the fact that it seemed like these people were some of the best borrowers out there. And so we felt like this segment of people both is a group that is in need of credit and is a group that could be underwritten at very reasonable rates because they have good employment prospects, they have a good job, and they are sort of the type of person that you would very much want to lend to. And so we began doing our lending product at Upstart precisely to serve this segment of people.
So when it comes to underwriting, which is generally a core competency for everybody on this panel, how are you leveraging big data? How are you using data to do something unique and proprietary and kind of push forward and expand the pool of who actually can access credit?
Well, one thing, we had a hypothesis when we started the business that who you associate with would be a predictor. Sort of these homophily-based algorithms that had been proven out in epidemiology, where if you hang out with smokers, if you hang out with people who are sexually promiscuous, if you hang out with obese people, you tend to take on those characteristics. And we thought that maybe this also applies to consumer finance, and what we found is that's true. And that has become one of the core elements of our underwriting process. So with every repayment we get, it not only improves the borrowing capacity of that person who repaid us, but actually the people they're closely connected to. And as every time we get a missed payment, that also affects the entire community. So the graph gets smarter and smarter with every repayment and with every person who joins it.
So somebody comes to you and they authorize their Facebook account, and you get to view their social graph. And what are the indicators across the social graph that actually enable you to provide something capital?
Well, one of the big ones is who you associate with. So we're all connected by about 4 hops. Everyone in this room, almost everyone in the world. And you can measure those connections and say, are you more connected to bad borrowers or are you more connected to good borrowers? And I think that's something that we've developed that's fairly proprietary. And then, of course, all the any big data company is going to do sort of the Bayesian algorithms, just basic pattern recognition. But I think that's one that we're pretty proud of.
At Cabbage, we started the business using data that hadn't been used previously because we were addressing a market that no one had been able to tap before. So it started out with just using interesting, unusual data. And what we've learned over time is what's really important is the context of the data and the interaction of the data that we're able to collect. And as we get more and more access to more types of data, we're learning that every customer we have is different. So Rob coined a phrase we call fingerprint underwriting, and I think that's the most unusual thing we do is, you have to look at every customer as an individual, and that it's not just do you say yes to them, it's how much do you give it, how much cash do you give them, when do you give it to them, how do you, change those things over time, and what's the rate? And it's not static. It's not like this just happens when you originate them and that's it. We're constantly monitoring them so we can make the best decision.
Yeah, no, I think that's a really, really true point. So much of traditional lending is about standardizing the data that you might see in a particular borrower. So in consumer lending, they boil you down to a FICO score and an annual income and have you defaulted in the last couple of years on something or other. And it's this flattening that we think loses a lot of the potential for what lending can do. So from an on-deck perspective, in a given hour, as we're taking applications from small businesses all around the country, we might have a furniture store that's been around for 20 years, and we might have a restaurant that's been around for 18 months. So this idea of how do you make a robust credit decision when in one case you'll have a business that has a ton of data that you can collect. And then in the second case, you have a business that has a very thin file. And when do you weight different data sources over other data sources? This is sort of the part of the big data challenge that we think is really interesting from a lending perspective. You could have 100 different applications come through your door and use 100 different combinations of data sources to make your credit decision. And that's where the big data element of this really does come into play.
But it's not like people who work at traditional lending institutions are slow, right? They know this and they're extremely intelligent, so why aren't they incorporating some of the practices that you guys have across the board into their own underwriting and decision making?
So for us, in many ways, I think the challenge is that, as much as we call this panel and a lot of these challenges big data problems, we think of them sort of as small data problems where, you look out in the world and there is a lot of data, but it's usually structured in a way that's not useful to you, or it's structured in a way that makes it extremely, extremely difficult to use. And when we look at the segment of people that we underwrite, the data out there is a complete mess. So we're looking at people who don't really have credit files, so there's no use in looking at their FICO score because it doesn't mean anything when they've had a credit card only for 6 months. And what instead you can sort of see about these people is you see, okay, here's their college transcript, here are a bunch of classes they took. There's some historical evidence out there about how these things correlate to defaults on future loans, but it's often structured in a way where you don't have access to all the columns you would want in a single nicely formatted CSV. And so because of that, if you're just attempting to apply some kind of big data technique, just take your algorithm and throw it on this data set, you won't have a data set to do anything on. And so in order for us to have been successful, we've needed to really spend a lot of time figuring out how to combine data sets and sort of manipulate data in a way that allows us to actually use it for our modeling. And I think that's really the challenge. So I call it a small data challenge, not a big data challenge.
Yeah, and I think also it's getting the data in a format that it can be used is critical, but also just having it in a format that you can interact with it. I mean, we have 100 servers. They update, while we've been on stage, there's been thousands and thousands of updates. So just being able to manage that and access it in a timely manner is a whole skill set in and of itself.
What are these updates? Are they like, a borrower has a new friend?
A lot of it is you like a cat. Like little, like you just took a photo of your friend and you're in a photo together. So in aggregate, 99% of that is useless, but it turns out that if you're in a photo with someone who's a known criminal, that actually might turn out to have signal.
So you're actually detecting that. You're saying, hey, you are in a photo with an ex-convict, and therefore we probably will not lend you.
What we would do is we let the data speak for itself. So if enough people hang out with enough convicts who don't pay back their loan, then the system will get smart enough to say, hey, here's a new feature that should be added to the underwriting process.
So like, what are some of the most intriguing and unique insights that you've had from the social graph? It's like a cats versus dogs thing. What are some of the leading indicators perhaps from a social graph that somebody may default?
One thing that we found interesting is the language that someone uses changes over time. And I think when to us it's just numbers, so we kind of let the algorithms group the words together. But if you then look at them and say, well, what has it discovered here? You can sometimes see that there's certain words that when you're really desperate for money, you start to use, not just in a loan application, but in your correspondence with people you interact with.
Semantic analysis.
Semantic analysis. There's signal in language. And I think we had started in the mid-2000s a company that analyzed those data sets for hedge funds. And so we knew there was signal in it, and I think we were able to move quickly to start to apply those types of data sets to the underwriting process and the risk management process.
I think one of the big challenges is this issue of massive quantities of noisy, unstructured data where the credit signals are kind of few and far between versus more structured data that might be right on point for the type of loan you're trying to make or the type of performance in your borrower that you're trying to assess. And we struggle with that all the time. Like you think about a data source like an OpenTable or a Yelp, you're looking at both structured and unstructured information. The number of reviews, the frequency of reviews is structured, and there are signals in that, but there are also semantic analysis you can do on the content of the reviews, but you can get sort of led down a garden path sometimes because some person has a bad experience and they write a particularly obnoxious review. It doesn't always mean that making that customer loan is a bad idea. They could just be a tough diner, right, at a restaurant, and not someone who's going to objectively tell you how that business is performing.
You also have to, you also have to know how you're going to use that data. All of it is not used for the same thing. So social data, I think, is really important, even just for verifying identity, just for saying, okay, this business is a business, and they interact with customers, and they have promotions and specials. I may not use it to say, well, I think they're generating X amount of revenue, but the purpose, I think, is really important.
Yeah. So this kind of gets into a bit of like correlation versus causation. So on the small business side, you talk about OpenTable or Yelp or even Foursquare. How much of this is actually relevant and significant and directly correlates or actually causes a default or a successful loan?
I mean, to Jeff's point, we let the data speak for itself. So as we rebuild every successive model of the on-deck score, we look at what features out of the universe of features we're considering are really going to drive that credit performance and separate the bad loans from the good. And to be frank, the social data is not a huge driver of the score. It's much more centered on business performance, whether it's the cash flow moving through that business or the trends or the depth of transaction volume or the depth of customer base that business has. But on the margin, though, when some of those other data sources might be missing or incomplete, then you have to rely a little bit more on those social or noisier data sources to make a decision. So it's not a one-size-fits-all kind of answer, unfortunately. I think it's something where, and if I were in Jeff's business, the social data comes up a lot more because it's a consumer loan and not a business loan. At least we have a whole other set of data to analyze on the business side, which makes some of the social graph stuff maybe a little bit less relevant in our case.
And Catherine, since you're mainly looking at online commerce, do factors other than cash flow factor into your decision making, like how many reviews somebody has on eBay or Etsy?
Without a doubt, and just to clarify, we actually, more than half of the customers that come in today are offline businesses. Our roots are in online businesses, but we're seeing that shift dramatically over the last 6 months. But what you find is there's a lot of self-selection that goes on. So these marketplaces, for example, you can't sell on eBay if everybody hates you. And same thing goes with Etsy and every place else. So what you can look at that's interesting is what's the category in which you're selling, or how many transactions do you have, or if you're an eBay seller, it's indicative of risk if you have fewer bids on an item versus more bids on an item. But it really depends on the marketplace. It's very customized.
And Paul, I'm curious, you mentioned something about looking at people's coursework and the classes that they take. Have you seen any correlation between majors or minors and what performs better?
Yeah, absolutely. So, the previous question you asked about correlation versus causation is actually a sort of very relevant question here. And one of the things that we always do when we start looking at new variables is we like to start from first principles and ask ourselves, what is it that generally causes people to default? And, at its core, the answer is people don't default because it's like a fun thing to do. People typically default because they ran out of money relative to their expenses. And so, the first of many models that we built was actually a model to predict people's future incomes as a function of a whole bunch of different variables. And it's actually not very surprising at all if you just stop and think about it for a moment that variables like your major or your college GPA or even your SAT score way back from high school are actually things that are predictive of your income in the future. They're predictive of your ability to get a job. And certainly, I don't want to say that it's predictive of all kinds of success because, for example, there are many people who just sort of don't go the traditional path and end up starting a successful company. But as far as consumer lending goes, we're not trying to find all the superstars. We're just trying to find, reliable people who are going to be able to pay back, make their monthly payments. And for those people, you can actually do a very good job predicting whether or not they're going to be able to find steady employment if you know what things they studied, what skills they have, what their track record was in school.
So I'm curious, what's the best major? What's the best thing to major in?
Not a big
computer science.
There's actually it's not very surprising. Tends to be STEM majors are better than non-STEM majors. As you get more towards things that sound like computer science, it ends up better than things that sound less like computer science. Sort of more applied things are generally better than less applied things. But that's not always true, and I think one of the sort of, again, these small data challenges is in actually understanding what the heck a major means. Because, for example, a major in IT is very different than a major in computer science, but in terms of the actual words, they sound kind of related, but they're completely different majors and they mean different things in terms of what somebody's future employment prospects typically look like.
So you all use data to effectively not have to hire as many people as well and automate a lot of processes. To what extent can underwriting enhanced by big data actually lead to automated processing? Can you never have to talk to a human, and at what point does that actually break?
Well, I think a lot of the algorithms are Bayesian, so they're probabilistic. So you don't say, this person is this way or that way. You say, well, we're 99% sure or 70% sure. So a lot of times you want to set your threshold based on the probability, and then perhaps change your workflow based on the underlying algorithms. So I think that's that's one place. But if you take the world's greatest algorithms, say chess algorithm, the world's greatest chess algorithm can beat almost every human. And the world's greatest chess human can beat almost every algorithm. But if you take a pretty good algorithm and a pretty good human and you pair them together, they're way more powerful. And the problem with algorithms is they don't do well with black swan events. So I think you could leave money on the table and just say we're going to do full automation of everything. But I think the best underwriting is where a large portion are handled through algorithms, and then exceptions are inspected or somehow involved with humans. Because humans are good at processing certain types of information.
But how do you detect those exceptions?
Algorithms.
Yeah.
Exactly. Kind of seriously, that's sort of what we're doing. Yeah. But it's interesting.
It depends on what you mean by automated as well. So, I think about Cabbage. 99% of our customers don't interact with us at all from the point of coming to the site to when they take cash. But that's not to imply that there aren't humans involved in the business. I mean, it's not like the Borg is running, in the background and we're just in Hawaii. So we've got a team, a credit risk management team, we've got a data science team, and those guys are interacting with the models that are being developed, and they're interacting with the exceptions. And so I think you have to have both of them. It's a matter of where the automation occurs and how you can gain efficiencies. I don't have to hire a lot of new people to put on a lot more customers, except for customer service, which is great. I can keep the same number of developers, and I can keep the same data science team and the same risk management team, and quadruple my business.
We prefer to keep the sort of human element of underwriting very low, because we generally believe that it's hard to have a good intuition about what the coefficient of GPA on default is, and so we don't like it when humans interject their own subjective biases into that process. But what we do is when I think we recognize that our algorithms are continuing to improve, and that's something that we're going to be doing forever. And one of the key inputs certainly is when we notice that the algorithm isn't working particularly well on a certain segment of people, and that could be because we're ignoring systemically some variable that's important. Maybe we're misunderstanding what a certain type of major actually is or means. And so the human feedback is very important to making improvements in the algorithm, but it sort of is a feedback process that goes through the algorithm as opposed to just having the human sort of decide on each individual loan.
Yeah, no, I think one of the interesting things I think you can get into is a little bit of a trap where you say, okay, the algorithm's doing well on these types of situations and not on these. Then you have a human review what the algorithm did, and looking at the exact same data, they rely on intuition to make a decision. And humans notoriously underperform algorithms in those kind of situations. And there's a lot of famous cases of this. So what you really want is, if you're going to get a human involved, they have to be doing something different and pulling in different data than what the algorithm was pulling in. And so while there's a million things that are easy to automate and pull in, in the core part of your business, we use the humans for that extra level of detective work required. That sort of goes above and beyond what the systems we have do, and then we find it to be quite effective. I think the other thing we find to be quite effective is where humans and algorithms work together well is in feature generation. So computers can come up with their own features, but only a human might think to say, I don't know, how far does this business owner live from that business? That's something a computer is going to think of on their own, right? But a human sort of says, gosh, I'm running a restaurant in New York, but I live in San Francisco. Like, that's a little weird, right? That's the kind of thing that sort of stands out. And so that's another opportunity, I think, to use human beings, is to make the algorithms have better features to work off of, but then let the computers figure out how to weight the different features to generate the ultimate decision.
So outside of underwriting, one of the biggest problems that any lender encounters is customer acquisition. And I overheard you on a panel the other day talk about employing many statisticians who focus entirely on using data for customer acquisition. Across the board, how have you used data to actually better target and acquire customers?
Yeah, I mean, I can start quickly, but it's we sort of divide our data science team into two divisions. There's a credit component and a non-credit analytics component. I think all of these lending businesses really, forgive the pun, lend themselves to data science at all phases of the funnel. So for us, there's 28 million small businesses in America. There's like 8 million of those that kind of fit our target profile. They need to be full-time business owners, at least 100,000 in revenue, been around for at least a year. And so within that set, that sort of defines who we can market our product to. So what we have is a number of folks in our data science team who just focus on marketing effectiveness within that set of 8 million businesses, and we're constantly collecting more data on those businesses to try and get better at our targeting and lower our ultimate cost of acquisition.
Yeah, the nice thing for us in this area is that a lot of the variables that we're adding to the equation that we're using, things like the school you attended, or even your sort of secondary variables like your SAT score, are things that are going to be highly correlated with publicly visible features of a person. So for example, you can go on Facebook and you can target ads at people who graduated from certain universities. We know what the distribution of test scores at those universities is, so it's pretty easy for us to figure out what groups of people might qualify, versus if you're trying to figure out what people's FICO scores are, that information typically is not publicly available. It's certainly not available on a place like Facebook or a place like LinkedIn. So it's relatively easy for us to target versus traditional lenders.
Yeah, there's nothing more frustrating than spending money to get a customer who you then give cash to that never gives it back to you. So I think unlike e-commerce, where incredible advancements of using big data to target have been made, I think it's even more important in lending. And we're able to use the graph information to say, okay, this is the person who repays. We want to target their community specifically, and then we want to target people who fit that profile also. So you can be incredibly efficient in targeting people who have a high likelihood of then converting into a product.
Lookalike modeling.
Yep, but lookalike, but also connected to. So two separate targeting approaches.
Marketing folks have a tendency to want to focus on, well, I have to spend this many dollars to acquire a customer. So we've had to work really hard to change that to where we're looking at profitability at the customer level, and that's required a lot of segmentation. So we have so many data sources, we have so many channels where customers are coming in, it takes a lot of time to slice and dice all that information. So our data team built a tool that we can use so that our marketing folks can go in on their own and do this analysis without having to engage necessarily our data science team, and they can decide for themselves, well, this channel's working well and this channel's not, and it's based on all these factors that ultimately get to a profitability number, and I think that's really important to get everyone rallied around that cause.
So, I mean, does a tool like that actually say, hey, here's a bunch of customers that we've never talked to, we've identified who they are individually, let's reach out to them, or is it more higher level, where it's like, in these buckets, we should start thinking about reaching out to people?
It's, well, okay, so that's one side of it is who do I go out and talk to and how do I find them? Another one is, what channels are performing the best and how do I get more people in that channel? Or what channels do I want to eliminate because they aren't very good? So, the tool can help you make those decisions. It can inform those decisions in real time.
Jeff, you had mentioned that there's nothing more frustrating than lending money to somebody and having them not give it back to you.
Spending money to get them as a customer. Yeah, exactly.
Well, let's just pretend what I said is what you said.
Okay.
Around debt collection, how are you using data to better enhance that process to mitigate either defaults, or if somebody does default, to actually try and recoup some of that?
Sure. So we do ongoing monitoring. We actually just launched a credit card product in Colombia, so we'll probably need to up our game on the ongoing monitoring. But with these large data sets, you can make decisions about what's the best way to reach somebody, what's the best time. And when I say the best way, I mean, do you want to do it through Facebook? Do you want to do it through their phone? Do you want to do it through email, by picking up the phone? And there's an optimal time and place to reach every single customer. With enough data, you should be intelligent that you're doing it in an efficient manner. And then there's also the risk profile changes in the course of a loan. So maybe for some folks you want to leave them alone and not dedicate resources to to maintaining the relationship because you know it's going to come in and it would just be annoying. And for others, they're at risk, so you want to be more aggressive in making sure you're maintaining that connective tissue with them.
So all these different levels of loan servicing, like the stack, from targeting customers and acquiring customers to underwriting and then debt collection, and using data to do all of these things better. Does this need to be a proprietary core competency that you develop internally, or can there be entrepreneurs in the audience who have companies and software that's specific to each of those levels of the stack that you would actually use? Is there an opportunity to be a service level provider?
I think we have need for companies that are service providers in terms of ease of accessing certain types of data. I think the actual analysis of that data is something that's always going to be proprietary to us, and I expect for many lenders that's something that has to be one of their core competencies, because nobody else is going to be as incentivized as you are to be good at that, and being bad at that really means that your business shouldn't exist, and it probably won't exist if you're bad at it for a long time. So for us, the distinction is we like companies that help us do more analysis by providing us more data or making it easier for us to get data from customers without them spending a lot of effort, but we're going to always do the analysis in-house.
I think banks use a lot of third-party software, whether it's their core account management platform, whether it's collections platforms, risk management platforms. They tend to use lots of different platforms. And I think what you said about helping them get access to the data is very important, but they're also generally not looking for extremely sophisticated activities. They want simple things. So for example, we maintain connectivity to the transaction information, so we know if a customer is delinquent, if they're actually still in business. So you've got two types of people who don't want to pay you and can't pay you. This allows us to make sure that the people who don't want to pay us but they're generating revenue are prioritized high in collections, and we can go after them. That's the kind of thing that I think you could provide as a service to an institution, and they would be able to use it, as long as it's really simple to toggle the criteria.
Yep. So credit bureaus were set up very geographically constrained and using mainly transactional data. And I think I think 10, 20 years from now, you're going to kind of laugh that was how things were done. Because relationships and these data sets are really global in nature. And I think there'll be a sort of global trust graph that is opt-in. So our members choose to share this information with us, and then they choose to share the summary information with someone who provides a product. So I think there's a network effect where with every single repayment anywhere in the world, any of the loans that we're supporting, it improves the entire system. So I don't think you're going to see, for this particular type of risk management, I don't think you're going to see a whole bunch of different people doing different parts of the stack. I think you're going to have a giant trust graph that partners to Lendo can tap into with the permission of the borrower. So it's borrower-centric as opposed to lender-centric data.
So I find that very interesting because in the US, there are a lot of regulatory hurdles when it comes to actually using data. So if you wanted to provide a consumer loan in the US, would you be able to tap into the trust graph?
So that's a great question. We operate outside the US, so I'm certainly not an expert on US regulation. But I do know that our customers, our members, are willing to share that through the filter of our service. Whether or not a US lender could then digest it or how they could use it, I'm not an expert. But I do know that we've essentially eliminated fraud. There's so much data in someone's social footprint, especially when you connect it to other people, that you can't fake that. And I think that you'll see a lot more innovation outside the US before you see it here in consumer lending.
How about on the business side, restrictions at the federal level or state level when it comes to what you can and cannot do?
Yeah, like Jeff, I'm not an expert on it, but we see signals in the data all the time that we don't think we can use. Like I was having a conversation with a number of the nonprofit, like micro lenders, and there was an assertion among them that women pay back loans better than men. That is not something we can use to make a credit decision. we see weirder signals than that. We see people with middle names do better than people without them. Why? I have no idea, but you can't use that either. So it's important to know the limits of data, and I think be very conscious and very transparent with your customers about what data is getting factored into the credit decision. And we make a very strong point of saying your Facebook and your Twitter activity is not something we're looking at. What we're looking at is how your business is performing online versus you as a consumer. And I think that distinction is important because I think it will become unsettling at a certain point if some of these things that are either more based on what type of consumer it is, the gender, the race, the ethnicity, whatever it is, that can't be used. But then you feel like there's a lot of data that's one level removed from that people might start to use. And that's a slippery slope. And so I understand why the regulators, I think, have a point of view on this because it can get to a place that you don't want it to go.
I think one of the reasons commercial lending is taking off so much is because there are fewer regulations than consumer lending. So we are able to use a lot more data than we would be able to if we were a consumer lender. And I think the idea is that business owners are more sophisticated than consumers, and so they're able to make more informed decisions.
So do they feel like this is an invasive practice at all? Do they find that you're using this data on either the consumer or the business owner or the business itself? Is there almost an invasion of privacy? Are they okay with this, or is this something that they embrace?
Well, one thing I've noticed is the markets we operate, the default situation is there's not a lot of credit. So the regulators' general position is, wow, you figured out a way to improve and extend credit. This is exciting. How can we help you? We're generally supportive. I think in the U.S., most of us when we go home, there'll be a credit card solicitation, or we could get credit if we want it. So there, I think the regulators have taken a stance of, wait a minute, is this going to exclude somebody from getting credit, or is this going to increase the cost for somebody? And when your default position is you can get credit, that seems like an appropriate action. So I think that sort of that lens drives everything.
I think there's a positive side to collecting this data too, which is the more data we can collect ambiently, from the internet and from public sources and third parties, the less data we actually have to ask the customer for during the application process. And so what the real pain point that a lot of our products are addressing is that business owner who wants to go to a bank, and get a loan, but then they have to bring in like 14 shoe boxes full of documentation and their personal tax returns and their future business plan and all this extra stuff, right? So the more stuff that we can collect for them, the easier we make the process on them, and that's a big selling point of this type of company and this type of product.
Yeah, I think people are generally, for us, pretty happy to give us their test scores and their grades if it means they're going to save a lot of money. It's something that I think young people are very used to giving. So when you apply for a job, you typically hand in your resume. It often has your GPA and your major on it. So we're asking for things that employers are already collecting, a lot of other people are already collecting, and in our case, it actually directly translates into the benefit of getting lower rates.
I think a lot of people in this room would be shocked at the amount of data that folks are willing to provide. People say this to me all the time. People give you access to their bank account. People give you access to their payment processing data. And our number one complaint from customers is, we wish you'd give us more money than you gave us. And the next one is, we wish you would charge us less. And then way, 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 way down on the list is, I don't want to share this data with you. We just don't have that complaint.
And to Noah's point about being able to ask less information, this is super important as we move to a mobile-first environment. I mean, you do not want to be typing in all that information on a mobile phone. So if we can ingest that, it streamlines it considerably.
And you see most of the loans originating on mobile devices, or?
In some markets, but we're still heavy Facebook actually. So people apply actually inside of Facebook, and work computers is another large source for us. But increasing, mobile's growing like crazy for us.
So I think we have some time, with around 5 or 6 minutes left for audience questions. If anybody has anything they want to ask. What's that? Oh, there is a mic right here, yes.
As someone that's played around with the data a lot, frankly, even the best predictor variables really don't explain that much variance. There's a great deal of randomness in loan performance. Can you speak at all to the improvement that big data and cat pictures can provide to predictive power?
say cat pictures?
I said there's a lot of noise in the data. Yeah. Well, I think we've been able to basically have loans perform the way we expect them to within bands. And we just did a pilot with a independent lender where using our scoring combined with their traditional scorecard, they were able to extend, when they backtested, they were able to extend credit to a larger group than they would have otherwise, and they were able to avoid 3 points of default as a result of layering in our scoring. So there's definitely considerable signal in there.
A good analog for what we do is looking at historical student loan default rates. And it's pretty astounding. If you look at all student loans, the average default rate on those is about 16%. If you just zoom into the top 50 schools, it's less than 1%. If you're zoomed into the top 100 schools, it's less than 2%. So in terms of just one single variable, the school attended explaining defaults on student loans, the predictive power of that is tremendous. Now, what we do is we throw in a whole bunch of additional variables that are sort of go one level deeper. So we're asking not just where did you go to school, but where did you go to school, what did you major in, what were your grades there, what were your test scores, and sort of each layer gets us another big improvement to what just the first level gave. But the first level is sort of publicly accessible, so any of you can just go online and look the stat up for yourself, and it's pretty astounding.
Hi, thank you. My name is Jordan Salvit. I have a background in computer science and machine learning, and I'm curious, you mentioned that certain factors like school is extremely important and a great indicator. That one factor, you said the top 50 schools, here it is, it tells you right off the bat what the default rate would be. But at the same time, I forget who mentioned before, I can't say eye color. I don't want to use that factor because that's discriminatory. Where do you draw the line of what factors you can use and where you can't when eye color may actually give you a 0.06% default rate and be even more valuable than school?
Yeah, so fortunately for us in consumer lending, there are quite a few regulations that sort of define what variables you are not allowed to use. So we don't use those variables. We don't collect those variables for the purposes of underwriting. We don't show those to investors on the platform. So there's really not an opportunity to use any variables like that. And we're pretty vigilant in terms of making sure that the variables we are using are not sort of very close proxies for essentially the same things.
Anybody else with a question? Okay, thank you.